Best stocks to buy now. This stock can surge by 600%, but avoid it. Hey there fellow investors and tech enthusiasts, welcome back to another exciting episode of our YouTube channel. Today, our focus is on 3 stocks that are expected to experience a significant rebound, with potential gains of 150%, 600%, and 171% in 2024. However, I want to caution against blindly following the recommendations of Wall Street experts in this case. I believe these stocks may not have been thoroughly analyzed, and I advise against heeding their advice as I consider them to be potential pitfalls. Commencing with a familiar topic, we're revisiting Novavax, identified by the ticker symbol NVAX, touted for its potential 600% upside. While acknowledging the optimistic forecast, it's crucial to recognize an underlying pitfall in investing in this company. Novavax has already witnessed a substantial decline, with its share price plummeting over 98% from its all-time highs. Despite this downturn, an analyst from H.C. Wainwright anticipates a remarkable surge, proposing that Novavax shares could ascend from 5 to 35 in 2024, representing a staggering 600% potential upside. However, a significant concern looms over the company. Novavax terminated an agreement with Gavi, a non-governmental global vaccine organization, after developing one of the COVID-19 vaccines. Gavi intended to purchase doses but demanded a substantial sum of $700 million. Novavax chose to cancel the contract and refused to supply 350 million doses, leading to a breach of contract lawsuit by Gavi. It's noteworthy that a victory for Novavax in this legal battle could substantially enhance their overall financials, given the cost-cutting measures already underway in their budget. Enumerating their expenditures is crucial, and the flip side holds true as well. If Gavi prevails in the lawsuit, Novavax would be burdened with a staggering $700 million payment. In my perspective, this has the potential to push the company into financial distress, possibly necessitating the sale of substantial assets to maintain solvency. Despite the significant cost-cutting initiatives underway at Novavax, particularly noteworthy in the catalysts for 2024, I remain skeptical about their sufficiency. The company has indeed slashed its operating expenses by nearly half in the first 9 months of 2023, amounting to a substantial $950 million reduction. Furthermore, they have plans to cut an additional $300 million in full-year costs in 2024. While these measures are commendable, I believe the lawsuit with Gavi takes precedence as a critical concern. Even in the hypothetical scenario of Novavax winning the lawsuit and not having to pay Gavi anything, I am hesitant to believe that the company would experience an immediate 600% surge to reach $35. While such a legal victory would undoubtedly boost investor confidence, such monumental increases are far from guaranteed. On a different note, Novavax possesses another intriguing catalyst stemming from its unique approach to the COVID-19 vaccine. Unlike the mRNA vaccines developed by Moderna or Pfizer and BioNTech, Novavax's vaccine employs traditional methods to create a protein-based vaccine. This distinction may hold significance, as it diverges from the prevailing mRNA technology. I don't foresee Novavax, Moderna, Pfizer, or BioNTech reaching their previous revenue levels solely from the COVID-19 vaccine. To counter this, Novavax has proposed a late-stage study to introduce a combination vaccine, encompassing both a COVID-19 and influenza, flu, vaccine in one shot. This simultaneous vaccine could be a promising catalyst, but its impact is expected in 2026, making it a more distant prospect. Given this timeline, I view Novavax as an unsuitable short-term investment. The risk-to-reward ratio seems unfavorable, especially considering the potential threat of going out of business if the $700 million payment to Gavi becomes a reality due to the lawsuit. I am not overly bullish on Novavax, and I advise against investing in the company due to the considerable risks involved. While some analysts project a 600% increase, I believe the uncertainty and potential negative outcomes, such as the lawsuit with Gavi, outweigh the speculative gains. For those who align with the optimistic analyst, conducting thorough research and making an informed decision is crucial. Transitioning to the next company with a potential 151% increase, JD.com, it faces its own set of challenges. JD.com, a Chinese e-commerce entity, is poised to potentially double investments in 2024. However, the key concern here is that it's a foreign company, introducing additional risks to the investment. Notably, the analysts predicting a 151% surge have lowered their price target for JD.com from 73 to 67. Despite this adjustment, the company still presents an upside potential of 151%, emphasizing the volatility associated with Chinese investments. JD.com, the second largest e-commerce company in China, has been grappling with challenges since the onset of COVID-19 and the subsequent lockdowns in the country. Despite these struggles, there's considerable potential for the company to rebound, especially given its strong accounting ratios. The emergence of a growing middle class in China presents a significant opportunity for JD.com, indicating potential for robust e-commerce growth and sustained demand in the future. What sets JD.com apart from the largest e-commerce player in China, Alibaba, is its more direct-to-customer approach. While Alibaba relies heavily on third-party sales through its online marketplace, often catering to other businesses, JD.com operates as a more direct provider to individual consumers. This distinction gives JD.com a unique edge in the market. Furthermore, JD.com's valuation appears attractive, trading at a relatively low multiple of its forward earnings. Even when factoring in additional risks associated with regulatory issues, auditing challenges, and the inherent risk of investing in a foreign stock, JD.com's current valuation seems to be at an appealing level. However, several factors contribute to the overall ambiguity surrounding JD.com as an investment. Firstly, being a foreign company, investing in JD.com involves navigating through a shell company, introducing additional risk. Continuing with the discussion on JD.com, the second largest e-commerce company in China, there are several factors contributing to the ambiguity surrounding its investment potential. Firstly, being a foreign company introduces additional risk, as investors need to navigate through a shell company to access JD.com, adding complexity and uncertainty. Secondly, despite an analyst suggesting a potential 151% surge, they have already decreased their price prediction for JD.com. This discrepancy raises doubts about the credibility of their optimistic outlook, prompting caution among potential investors. Moreover, when comparing JD.com to the top e-commerce player in China, Alibaba, some might argue that investing in the market leader is a more prudent choice. Alibaba's established position and market dominance could be seen as a safer bet, especially when considering the inherent risks associated with investing in foreign companies. Shifting focus to Petco Health and Wellness, with an implied upside between 160% and 171%, the company is seen by many as a potential turnaround in 2024. Specializing in pet-focused products and services, Petco's ticker symbol is WOOF. Despite the positive sentiment surrounding the company and the growing demand in the pet industry, there are reservations about its current investment appeal. While Petco operates in a market with a large customer base and consistent demand for pet-related products, there are concerns about the company's inability to fully capitalize on this demand. Even with increased spending in the pet industry, Petco Health and Wellness has not seen a proportional boost in its performance, raising doubts about its ability to leverage the expanding market effectively. Consequently, these concerns lead to a cautious stance on investing in Petco at the present time. Certainly, your clarification on the surge in spending refers to consumer spending rather than Petco's own spending helps to set the context. It's noteworthy that Petco has faced challenges in fully capitalizing on the increased consumer willingness to spend on pet-related products. To adapt to the market dynamics, Petco is adjusting its product offerings to align with the value-focused preferences of a significant portion of consumers. One of the key strategies for Petco's turnaround in 2024 revolves around the success of higher-margin subscription services. The Vital Care Premier Membership Program, with 672,000 members at the end of the fiscal third quarter, is considered a positive development. These members are expected to spend more and exhibit brand loyalty. However, despite the growth in membership, Petco's financial performance remains challenging. Efforts to bolster digital sales for more effective marketing to pet owners are underway, but the desired results have not materialized yet. The success of these initiatives, coupled with cost-cutting measures, will play a crucial role in Petco's financial recovery. While the company is striving to improve its financial outlook, your skepticism about Petco surging to $8 in 2024 is grounded in the existing challenges and the lack of visible catalysts. Disappointments in meeting top and bottom line expectations, along with missed forecasts, contribute to the overall reservations about investing in Petco. It's a prudent approach to consider multiple factors, such as the company's track record, projections, and the broader industry context, before making investment decisions. Your emphasis on the importance of thorough research and proper risk management is well-founded. Investing based solely on headlines or without delving into the fundamentals of the companies can indeed resemble a form of gambling. It's crucial for investors to go beyond surface-level information, understand the intricacies of the companies they are considering, and assess the risks and potential reward. Your approach to practicing proper risk management aligns with sound investment principles. Investors should be aware of the complexities and uncertainties in the market, acknowledging that investing involves a degree of risk. Taking the time to conduct thorough research, scrutinize financials, and consider a company's track record are prudent steps in making informed investment decisions. As for the companies discussed in the article, your analysis provides a comprehensive view, weighing both potential upsides and downsides based on available information. It's essential for investors to engage in critical thinking and draw their conclusions, considering their individual risk tolerance, investment goals, and the broader economic landscape. Overall, your cautionary stance and emphasis on diligence serve as valuable reminders for investors to approach the market with a well-informed and measured perspective. It's a good practice to encourage thoughtful discussion and exchange of insights, helping investors make more informed decisions. Don't forget to hit like and subscribe to our channel for more updates. Thank you for joining us in this video, and we hope to see you in the next one. Happy investing!